Right now, something is shifting inside the global system that almost no one is fully paying attention to, and yet it may end up defining what happens next across economies, markets, and geopolitical power itself. It is not loud. It is not dramatic. There are no breaking alerts announcing it. But beneath the surface, a very specific pattern has begun to form. Oil and silver, two of the most strategically important commodities in the world, are rising together at the same time. And historically, when this happens, it is never random. It is not just a market reaction. It is a signal. A signal that the most informed and well-positioned capital in the world has already started moving in anticipation of something bigger. Not reacting to events, but preparing for what they believe is coming next. And if that interpretation is correct, then what we are seeing right now is not the peak of global tension. It is the early stage of a much larger shift that has not yet fully revealed itself. To understand why this matters, you have to stop thinking about war as something that begins with a single event. Modern conflict does not start with the first strike. It starts much earlier, inside systems that most people never see. Supply chains begin to tighten. Strategic resources begin to move. Financial flows begin to reposition. Long before the visible phase of conflict emerges, the invisible phase is already underway. And that invisible phase leaves behind patterns. Oil and silver are two of the clearest indicators of that process. They reflect not just current conditions, but expectations. Expectations formed by institutions that operate with deep intelligence, long-term strategy, and access to information that goes far beyond public headlines. This is where things become serious, because when both of these commodities begin moving in the same direction, it suggests that multiple layers of the global system are aligning around the same conclusion. That risk is increasing, and that the current environment is becoming more unstable. Oil sits at the center of everything. It is not just an economic resource. It is the operational backbone of modern power. Every military system depends on it. Every logistics network relies on it. Every industrial economy is built on it. When there is even a hint of disruption to oil supply, markets respond immediately. Not because disruption has already occurred, but because the possibility of disruption is enough. That is what makes oil different from most other commodities. It does not wait for confirmation. It reacts to risk itself. And right now, that risk is building across multiple regions simultaneously. The Middle East remains one of the most critical zones in this entire equation. It is not just about the reserves located there, but about the pathways through which global energy flows. The Strait of Hormuz is one of the most strategically sensitive choke points in the world. A large percentage of global oil supply passes through this narrow corridor, making it extremely vulnerable to any form of disruption. Even the perception of instability in that region can move markets instantly. A single escalation, a naval standoff, a threat to shipping lanes, or an attack near critical infrastructure can trigger rapid price increases. And this is where the situation becomes more complex, because the current risk environment is not defined by isolated incidents. It is defined by persistence. The tension does not disappear. It lingers, evolves, and compounds. At the same time, the conflict in Eastern Europe continues to reshape how markets perceive energy security. Infrastructure has become a direct target. Fuel depots, power grids, and transport networks are no longer secondary considerations. They are central to the strategy. And every successful disruption reinforces a message that markets cannot ignore. Energy systems are vulnerable. Supply chains are fragile. And when that perception takes hold, it changes how oil is priced. It is no longer just about how much oil is being produced. It is about how reliable that production is under pressure. But this is only one side of the signal, because while oil reflects the risk of disruption, silver reflects something different. It reflects preparation. And this is where the pattern becomes far more powerful. Silver is often misunderstood as simply a precious metal, a lower-cost alternative to gold. But in reality, it is one of the most strategically important industrial materials in the modern world. It is embedded in electronics, communication systems, renewable energy technologies, and advanced defense equipment. It is part of the infrastructure that supports both economic growth and military capability. When geopolitical tension increases, silver demand rises in multiple ways at the same time. Defense systems require it. Technology production requires it. And at the same time, investors begin to move into silver as a protective asset. This creates a rare alignment of forces. Industrial demand and financial demand begin pushing in the same direction. And when that happens, the price does not just increase gradually, it accelerates. Because the system is being pulled from both sides at once. This is exactly what we are beginning to see now. Silver is not just reacting to current conditions, it is responding to expectations of increased demand under conditions of rising tension. And when you place that movement next to what is happening in oil, the signal becomes much clearer. Oil is pricing in disruption, silver is pricing in escalation. Together, they form a picture of a system that is not stabilizing, but preparing for a more complex and uncertain phase. This is what analysts refer to as a compounding risk environment. It is not a single crisis driving the system. It is multiple sources of instability interacting with each other at the same time. Eastern Europe, the Middle East, and the Indo-Pacific are all contributing to a broader landscape where risk is no longer localized. It is distributed. And when risk becomes distributed, it becomes harder to control, harder to predict, and harder to contain. In the Indo-Pacific, tensions are rising in ways that are subtle but significant. Military activity, strategic positioning, and economic competition are all intensifying at the same time. The relationship between major powers is shifting from cooperation toward sustained rivalry. Trade restrictions, technology controls, and supply chain adjustments are no longer temporary measures. They are becoming structural features of the global system. And this is where the deeper implications begin to emerge. Because global supply chains were built on the assumption of stability and cooperation. When those assumptions begin to break down, the entire system has to adjust. Materials become harder to source, costs increase, timelines become less predictable, and uncertainty begins to influence pricing in a way that is difficult to reverse. Silver, which sits at the intersection of these global networks, becomes especially sensitive to these changes. Its price begins to reflect not just current demand but the uncertainty surrounding future supply. And this is where the signal gains its full meaning, because when oil and silver move together under these conditions, they are not just reacting to what is visible, they are responding to what is possible. They are pricing in scenarios that have not yet fully materialized. And historically, this is exactly how early-stage signals behave. They appear before the broader system fully recognizes what is happening. If you look back at previous periods of rising global tension, you see similar patterns. Commodities begin to move quietly at first, not dramatically, not in a way that captures headlines, but consistently, as if the system itself is adjusting in advance. And by the time the full impact becomes visible, those movements have already established the direction. What we are seeing now carries that same structure. It is not explosive. It is not chaotic. It is controlled, steady, and deliberate. And that is what makes it more significant, because it suggests that the movement is being driven by long-term positioning rather than short-term reaction. Institutions managing massive amounts of capital are not guessing. They are allocating based on expectations, and those expectations, at least for now, appear to be pointing toward a period of continued and possibly expanding tension. This is where the economic consequences begin to connect with the geopolitical picture, because rising oil prices do not stay confined to energy markets. They spread through the entire system. Transportation becomes more expensive, production costs rise, food prices increase, inflation begins to build. At the same time, rising silver prices increase the cost of technology, infrastructure, and industrial output. And when both pressures occur simultaneously, the effect is not isolated, it is systemic. This creates a chain reaction. Higher costs feed into inflation, inflation forces policy responses, and those responses introduce new forms of pressure into the system. Central banks are already dealing with elevated inflation levels, and the tools they use to control it are limited when the source of inflation is tied to geopolitical risk rather than consumer demand. This creates a situation where economic management becomes significantly more complex. And this is why the current signal matters so much. Because it is not just about commodities, it is about alignment. Alignment between geopolitical tension, economic pressure, and financial positioning. And when those three elements begin to move together, it usually means that the system is entering a new phase. A phase where instability is not temporary, but structural. The question now is not whether something is happening. The evidence suggests that it is. The real question is how far this shift will go. Because if the current pattern continues, it implies that the forces driving it are not fading, they are strengthening. And if they are strengthening, then what we are seeing today may only be the early stage of a much larger transformation that is still unfolding. But the real turning point in this story is not just the presence of rising tensions. It is the way those tensions are beginning to connect, overlap, and reinforce each other across multiple regions at the same time. Because once instability stops being isolated and starts becoming synchronized, the entire global system behaves differently. It becomes more reactive, more fragile, and far less predictable. This is where we move from a world of contained crises into a world of continuous pressure. And in that kind of environment, signals like oil and silver are no longer just indicators. They become early warnings of structural change. What makes the current moment so significant is the emergence of what can only be described as a multi-front pressure environment. In previous decades, global instability tended to concentrate in one region at a time. Markets could isolate risk, adjust, and then stabilize once the situation became clearer. But that is not what we are seeing now. Instead, multiple regions are generating tension simultaneously, and those tensions are interacting with each other in ways that amplify uncertainty. Eastern Europe remains active, the Middle East continues to carry persistent risk, and the Indo-Pacific is evolving into a long-term strategic fault line between major powers. This overlapping pressure changes how markets interpret risk. It is no longer about a single event resolving. It is about whether the system itself can handle multiple sources of disruption at once, and increasingly the answer appears to be uncertain. This is why the behavior of oil is so important right now, because oil is not just reacting to current disruptions, it is pricing in the possibility that multiple disruptions could occur at the same time. Shipping routes, production facilities, and strategic reserves are all part of a network that depends on stability. When that stability is questioned across multiple regions, the pricing mechanism begins to shift. Risk premiums increase, not because something has already happened, but because the probability of disruption is rising. At the same time, silver is responding to a different layer of this same environment. While oil reflects vulnerability in energy supply, silver reflects strain within industrial and technological systems. Its supply chain stretches across continents, linking extraction, processing, and manufacturing into a single, interconnected network. And that network depends heavily on cooperation between major economies. When that cooperation begins to weaken, whether through trade restrictions, political rivalry, or strategic competition, the flow of materials becomes less efficient, costs rise, delays increase, and uncertainty begins to dominate. This is why silver is acting the way it is. It is not simply reacting to demand, it is reacting to the possibility that supply chains themselves are becoming less reliable. And that possibility carries significant weight in markets, because when reliability decreases, prices must adjust to compensate for the added risk. This is not just about current production levels. It is about the confidence that future production can meet demand under increasingly complex conditions. Now, when you combine these two movements, oil pricing disruption risk and silver pricing system strain, you begin to see a much clearer picture of what is happening. The system is not just under pressure, it is being tested. Tested across energy, tested across industry, and tested across global coordination. And when multiple parts of the system are tested at the same time, the margin for error becomes much smaller. This is where historical patterns become especially relevant. Because while every period is unique, the behavior of markets under pressure tends to follow certain recognizable paths. In the early stages of past global escalations, commodities often moved in ways that were subtle but consistent. Oil would begin to rise as risk to supply increased. Silver would follow as industrial demand expectations and investor positioning shifted. These movements did not wait for confirmation. They anticipated outcomes, and in many cases, those anticipations proved to be accurate. The important lesson here is not that history repeats exactly, but that markets often recognize shifts before they become obvious. What appears to be a quiet adjustment can actually be a reflection of deep structural change, and that is what makes the current pattern so important, because it carries the same characteristics. It is not dramatic, it is not chaotic, it is steady, and that steadiness suggests that it is being driven by long-term positioning rather than short-term reaction. But beyond the geopolitical and historical dimensions, there is another layer that cannot be ignored, and that is the economic consequence of these movements. When oil prices rise, the effect spreads through every layer of the economy. Transportation becomes more expensive, manufacturing costs increase, agricultural production faces higher input costs, and these increases do not remain isolated. They accumulate, they compound, and eventually they translate into higher prices across the board. At the same time, rising silver prices introduce pressure into sectors that are central to modern economic growth. Electronics, renewable energy infrastructure, medical technologies, and advanced manufacturing all rely on silver as a critical component. When its cost increases, production becomes more expensive, and when production becomes more expensive, those costs are passed through the system. This is how inflation builds not from demand, but from supply constraints. This creates a particularly difficult environment for policymakers. Central banks are designed to manage inflation primarily through demand-side tools, such as adjusting interest rates. But when inflation is driven by supply-side disruptions linked to geopolitical risk, those tools become less effective. Raising interest rates does not resolve disruptions in energy supply. It does not stabilize shipping routes. It does not restore broken supply chains. Instead, it introduces additional pressure by slowing economic activity and increasing the cost of borrowing. This is where the real tension emerges within the economic system. On one side, inflation remains elevated due to external pressures. On the other side, attempts to control that inflation risk slowing growth and creating financial strain. This balancing act becomes increasingly difficult as geopolitical uncertainty continues to rise. And this is exactly the kind of environment where markets become more sensitive, more reactive, and more volatile over time. For developing economies, the situation is even more challenging. Many of these countries depend heavily on imported energy to sustain their economic activity. When oil prices rise, their costs increase immediately. This can weaken their currencies, increase the burden of external debt, and force governments into difficult decisions about spending and subsidies. At the same time, because global commodities are priced in US dollars, any strengthening of the dollar adds an additional layer of pressure. Countries end up paying more for essential imports while their own financial stability becomes more fragile. This is one of the most overlooked aspects of global instability. The effects are not contained within the regions where tensions originate. They spread outward, affecting economies that are geographically distant but financially connected. And in many cases, these indirect effects can be just as impactful as the direct consequences of conflict. So the deeper question begins to take shape. Are we looking at a temporary phase of heightened tension that will eventually stabilize? Or are we witnessing the beginning of a longer-term transformation in how the global system operates? There is a growing argument that this is not temporary. Instead, it represents a shift toward a world where geopolitical competition becomes a permanent feature rather than an occasional disruption. The rivalry between major powers is becoming more sustained. Regional conflicts are proving more difficult to resolve. Global trade is gradually fragmenting into competing systems. And as this happens, the economic cost of maintaining stability increases. Markets must continuously adjust to new risks, new uncertainties, and new constraints. This is not a short-term cycle. It is a structural evolution. If that interpretation is correct, then the movement we are seeing in oil and silver is not just a reaction. It is an adaptation to a world where uncertainty is embedded into the system itself, where risk is not an exception, but a constant, and where financial signals must continuously reflect that reality. This is why understanding these patterns matters so much, because they provide insight into how the most informed participants in the system are positioning themselves. They reveal expectations that are not always visible in headlines or public narratives. And right now, those expectations appear to be aligned around one central idea, that the current phase of global tension is not ending. It is evolving. And that leads to the final realization. Signals like this do not appear without reason. They are the result of countless decisions made by institutions with access to data, analysis, and strategic perspective. When those decisions begin to align in the same direction, they create patterns. And those patterns over time tend to reflect reality. Right now, that pattern is becoming clearer. Oil and silver are moving together. Risk is spreading across regions. And the global system is adjusting in response. The only remaining question is how far this adjustment will go, and whether the world is prepared for what it may bring next.